Way to go. Welcome, folks. Welcome to today's Bob Benny Wealth Management Bobcast. Today is September 19th, Thursday. I'm Bob Benny.
I'm Jesse Thompson.
And we're just glad you're all watching today. Today's topic is September Spooks, Ghosts of the Market Past. And we're going to try to talk about stuff that's been going on currently in the market and the history of the market in September. There's actually four things we're going to talk about. Why September is a historically weak month for stocks, our market outlook and what the data says, what's going on with the economy, and how to protect yourself and be proactive.
All right, so let's go ahead and jump right in. What is the deal with September? So there is a kind of a market anomaly, meaning there's not really a logical explanation for this that goes on with the month of September called the September effect. And it happens not only in the US stock market, but in stock markets all over the world, where September is a little bit of a weaker month during the year for the market. There's not people have some different theories of maybe why that would be. People are getting back from summer and, now they're sitting down and thinking they need to trade, things like that, that still don't really completely make sense. It's just kind of a weird thing that happens. The month of September is actually the only month out of the year that has an average return that is negative.
That's over the last almost 100 years, like
since 2026.
Years.
I'll show you a chart here that has the S&P 500 returns for the past 98 years. And as you can see, September has an average return of negative 0.86%. It's the only one that is negative. Let me explain a little bit, because September is typically weaker for stocks during the year, but it's not always weaker for stocks, right, of course.
It's on the average over the last 98 years, the average. Some of those are good, some of those are not so good. Sorry.
Good. Yes.
It's the average.
So
take them all the returns, add them together, and then divide it by 98. That's what you get.
Got it. Okay. So part of what's driving that average down and making it negative compared to those other returns are some really bad Septembers historically. Notably, the worst was in September 1931. In that month, the stock market went down, as measured by the S&P 500, almost 30%, 29.6% in a month. Of course, that's around, Great Depression times, giant stock market crash. There's a bunch of different rules and things in place that happened after that to make sure that that kind of thing doesn't happen anymore. But there's also been a couple of other really bad Septembers in more recent history that also drive that average down. In 2008, in September, the market went down 8.9%, and more recently in 2022, it went down 9.4%. Typically, when we're talking about September, the last 2 weeks of the month have typically been the weakest for stocks. But does this mean that you just shouldn't be in the market in the month of September? No, it doesn't. Actually, 50% of the time, the large cap US stocks have had positive performance in the month of September. So, there's going to be good Septembers and bad Septembers. Kind of the reason why September has this negative average is because it's had there's been some really bad Septembers, and there hasn't been as many really good ones to offset those really bad ones that have happened. So overall, what does this mean for you? Not much. Really, the only reason we bring it up is because people talk about it, and there's almost a little bit of an inertia effect that goes on with September that people who know about this kind of expect that September is going to be bad. Some people put a trading strategy around September where they get out during the month of September. And then there's just this effect that the negativity kind of builds on itself, and
because the news media is going to be talking about it and jabbering about it like they like to. The news, we all have to remember, the news media is always trying to sell fear, particularly in an election year. And that may have an effect on the reason, or that may be part of the reason that September's have a different average than other months of the year is because during election years, a couple of months before the election, there's a lot of nervousness and anxiety and a lot of news-driven fear.
Sure.
Yeah.
So we're only really bringing this up just so that you're aware and that you're not surprised if there is some volatility in the stock market this month. Something that we always say and that we always want to remind people is that investing is not about certain days, weeks, months, or even a year or two of performance in the stock market or drawdowns in the stock market. It's about a long-term time horizon. And it's based on the performance that you're going to get, and the returns that you're going to get are going to be based on, you know, years in the market, and volatility, these ups and downs for short amounts of time is all part of the deal. And it's all part of the investing for the returns that you want to get from the stock market. So to show you that, as an example, in the S&P 500, which averages around 10% for an annual return
over a long period of time.
Over a long period of time, if you want to get that type of return, like from the S&P 500, you would have to tolerate, as has happened with S&P 500, an average of 3 drawdowns or corrections of 5% per year, 1 correction of 10% per year, 1 correction of over 15% once every 3 years, and a correction of over 20% once every 6 years. And that can be pretty scary for people. But what happens is the market goes like this. And over time, the average that you get goes like this if you stay in. So volatility is normal. It's all part of it. And it's not a time to make any moves.
That's right. So how's the market really doing? The market's really doing quite well. But we've seen, since the end of July, beginning of August, there was a big drawdown or a big drop in the market. In fact, August the 5th was the biggest sell-off in 2 years. The S&P 500 was down 3% and the NASDAQ was down almost 3.5% in one day. And and then it had a few days there when the whole S&P 500 was down, I don't know, 6 or 7%, but then it turned around. And Jesse's going to show the chart of it. So there you go. So this is the chart for just year to date for this year of the S&P 500, and move your little pointer over to where the beginning of the August thing was. There it is. Yeah, there's where that
right about here.
Yeah, that's August the 5th. And so we had that drop. And like I said, in a matter of a few days, it was back to where it was. The interesting thing, that was a Monday. And overnight, Sunday night, the financial news and the news media across the world started talking about this global sell-off that there was going to be, and there was already starting a global sell-off, global sell-off, global sell-off. I saw dozens of news articles that were using that phrase. It's almost like they were conspiring, and they love that global sell-off, global sell-off. So they scare the crap out of people, and some of the people jump on the bandwagon and sell off. We had a few customers call that had heard about the global sell-off and were worried about what was going to happen in the market. We urged them to not be fear mongers, not buy into the fear that the news media was selling. And everybody stayed in the market, except for one fellow who I couldn't talk out of, and he got out of the market. He's still out of the market, and he has missed out on the market coming back.
All of this.
Yeah, so move the screen. Here. Yeah, the screen, it's higher than it. The market right now is higher than it even was at the high in July of the S&P 500. I just looked at my phone a few minutes ago while Jesse was talking. Right now, as of right now, because we're having a pretty good day, as of right now, the S&P 500 is up 19.9% for the year. Well, people that panic and get out after the market's gone down a little bit and and they typically don't get back in time, they miss out on that. Somebody that just stayed invested for the whole year, and this is just in the S&P 500, has made almost 20% on their money, including going through these bumps in the road. So people are what in general, what happens a lot too in election years, and we've talked about this too, is as you get near the election, largely because of all the fear mongering that the news media is doing, people are uncertain, and uncertainty causes volatility in the stock market and certain people panicking and this and that. And so we want you to not be uncertain and not panic.
So the reality of how the companies on the stock market are doing is that they're doing overall really well. So the second quarter earnings came out for the S&P 500, and the year-over-year earnings were 11.3% for the S&P 500, which is the best year-over-year that we've had since the fourth quarter of 2021. Yeah, and I'll show you.
The earnings increase was 11 point whatever.
Yes.
Yeah.
Yeah, so
and that's the bottom line. The bottom line of buying companies has to do with what their value is and their intrinsic value, and their value is based on what they're making for profit. And so even though you're hearing this news and stuff like that, the bottom line is the companies, by and large, not all companies, and it's never all companies, but by and large, companies are making money, and they're making more money than they were last year, and substantially more money than they were.
And this is the growth for the second quarter by sector. And you can tell what the highest ones are: utilities, then tech, financials, healthcare, consumer discretionary. The S&P 500 overall, when this chart came out, not all of the companies had reported their earnings yet. It was 10.8 at that time. After more of them reported, it finished at 11.3. So these are even higher than what this shows, the way that it finished. But it's interesting because one of the things during that global sell-off that was to blame, it was a disappointing jobs report for the month of July, which we'll talk about in a little bit what the unemployment situation is, and it's still completely normal and good. And then it also talked about that people were disappointed in tech, or that they weren't they didn't think that AI
met their expectations.
Yeah, they didn't think that AI was paying off. Well, look at this. It was. All of the earnings were the earnings that came back from NVIDIA and a bunch of the AI companies were like bananas. They were awesome. And so none of that was rational. It was just a panic, fear-driven sell-off.
So about 80% of the companies on the S&P 500 exceeded the analysts' earnings expectations. And that's kind of interesting because that's been going on for a while. These Wall Street analysts that study these companies and get into all their books, and they get information we don't even know from the companies because they're public companies. They have to give them this information. They make projections of what they think the next quarter and the next year's earnings and profits and sales and all that stuff is. And they don't really have a dog in the hunt, so to speak, other than trying to be accurate. And 80% of the 500 companies on the S&P 500 outdid what the analysts expected them to do. So that's really good. So companies are still making money and they're healthy. So our next point is, how's the economy really doing? That's what companies are doing. How's the economy really doing? And so we saw yesterday, or some of you saw, maybe you didn't, that the Federal Reserve lowered interest rates by 0.5 point. Now, this is after the previous, 3.5 years, they had increased them, or 2.5 years, they'd increased them from 0 to 5.5%. Now they've moved them down to 5%. And that ends up having an effect on all other kinds of interest rates too, even mortgages that are long-term, 30 or whatever, it all has that effect. Well, they did that under the guise of that the inflation is going away and they've got inflation under control. And so it's okay to start lowering interest rates again. Well, that's a big fat lie. They don't have interest rates under control, or I mean, inflation under control. The Federal Reserve, by practice, never a couple of months before an election changes interest rates either up or down. They generally avoid doing anything anywhere around an election to be accused of trying to influence an election. Well, that's exactly what we believe that they're doing right now. They're trying to make the economy look better, saying, inflation's not that big a deal. See, we're proving it by starting to lower interest rates back down. Well, I can about guarantee you that as soon as this election's over, doesn't depend on whoever gets elected. As soon as this election gets over with, they're going to start raising interest rates again. I'm very confident of that because the inflation is there. It's not going away. It's double-digit plus inflation. Anybody that buys anything, that buys groceries, that buys whatever, knows that the inflation is there and it's real. And so the only tool the government has to fight inflation, other than lie about it, which is what they're doing, and that doesn't sustain itself very long. The truth always comes out with a lie. But the only real tool they have is to raise interest rates, and that's what we're confident that they're going to go back to doing is raising interest rates. So, go ahead. You were going to say some stuff about inflation. I don't want to jump on your stuff.
It's just inevitable that there is going to be inflation, and then it's going to take a while to tamp it down because they added 40% to the US money supply since COVID.
Yeah.
That's crazy. That's just inevitable high inflation, and it doesn't get fixed with a couple of years of semi-high interest rates.
Well, these aren't even high interest rates, really.
Right.
These are more like average interest rates.
And
what they were raising interest rates, the same thing happened in the late 70s and early 80s before you were born. But anybody can look it up, including I've shown you. Late 70s and early 80s had super high inflation, double-digit inflation. The government used the only tool it has to head off inflation, and that was raising interest rates. And we saw 30-year mortgage interest rates get as high as 18%. And then the inflation started cooling off, and then they started lowering interest rates back again. But, like right now, you can get a mortgage for 7% or slightly less after the Fed's, a 30-year mortgage after the Fed's thing. That's about historical average for 30-year mortgages. I remember when I first got my first one, it was right after, probably 1985, right after the interest rates got up so high and they came down, and I got my first 30-year mortgage at 8.5%, and I thought I was really fortunate, and I was at the time compared to double digit. But so now mortgage rates right now are still below historical averages, or right at historical averages. I don't believe we're ever going to see 2.5% or 2.25% 30-year mortgages ever again in our lifetimes. Maybe in yours, but not in mine. I'm near the end.
And just also something to note that I think is important, because every month the inflation rates, the CPI is released, right? And part of the reason for this interest rate decrease is because supposedly
they're claiming
the CPI has gone down, and now it's evened out around close to the 2% that the Fed wants it to be. Well, common sense tells probably everybody on this call, everybody that buys things, that the prices have not gone up only 2%, since
anybody
last
that
year.
buys stuff knows inflation is
And part
through the roof.
of what's going on is that calculation isn't what you think that it is. So in our minds, when we think of an inflation calculation, you would think of, I'm thinking of the specific basket of goods and services, last year, and then that exact same specific basket of goods and services this year.
Isn't that how they
And
do it?
how exactly, how have the prices changed between then and now? They don't do it like that. They can use things like substitutions when people stop spending money on things that have gone too high in price. So for example, if you have previously bought, last year you were buying New York strip and that got way too expensive. So now you have decided that you're going to just buy ground beef because that's all you can afford now instead. They're not measuring against the New York strip. They'll say, oh, people have substituted ground beef, so we're going to measure the ground beef price against the ground beef instead of against the New York strip, if that makes sense. So there's different ways that they can alter what the actual calculation is. So it's not just comparing apples to apples last year versus this year. They also change the weighting of certain goods and services.
It's totally
And
deceptive.
they can change things in the basket. So there's different manipulations that can be done to make the CPI look lower than it actually is in reality for those of us who are spending money on things.
And if they use the same formula that they used back in the late 70s or early 80s and early
With a
80s
fixed basket.
with a fixed basket, we would surely see double-digit 10 to 15% inflation, which we all know is going on, but anybody that buys anything. And so that's another reason why we believe that the interest rates are going to go back up, is because they're lying about why they went down. So the final thing regarding the economy is the employment rate. The employment rate is 4.2%. Historical averages are healthy. I mean, is 3 to 5%. So that's a healthy part of the economy. The only really unhealthy part of the economy, and it's significant, is this super high inflation. And so, we want to talk to you and give you some advice for how to protect yourself and how to be proactive regarding inflation and risk and all that stuff. So go ahead.
And regarding volatility in the market, if that the market is up really high today because of the interest rate decrease. But that's going to be a temporary thing probably, and we don't know what the rest of the month or from now until the election holds. And so if there's volatility, we want you to have some tools in your tool belt. And the first thing is going to be how you can protect yourself. And then we're going to talk about how you can be proactive and actions that you can take when there's volatility. So how you can protect yourself. The first thing is your portfolio needs to be invested for the actual amount of risk that you can handle. So you need to be invested for the potential downside that you can actually handle, so that when that volatility comes and your account goes down, you're not too nervous because you've been invested too risky for what you can actually handle and it's gone down more than what you can stomach. We have a really great tool that does that, where you can take a little questionnaire quiz and it gives you a risk number from 1 to 100. And that risk number shows, for that amount of risk, this is what you can expect as far as downside goes, and this is what you can expect as far as upside goes, because risk and return are tied together. If you want, a return up here, but you only want to take, this much, a little bit of risk, that's not how it works. You have to take risk to get return, and a proper risk management tool can show you what's appropriate for you.
Yeah, and we want to offer that to everybody on the webinar, and all of our customers. Many of our customers we already have gone through this exercise with. It takes maybe 15 minutes to come up with the risk number, and then we can also enter in people's investments and see, if their investments fit the risk number of what they're willing or what they're wanting to be. Maybe you're invested way higher than the risk you're willing to tolerate, or the other way around. But we want to offer that to you who are watching the Bobcast, and anybody that's your friend or family member. You want to make sure that their investments are set to the right amount of risk that they're willing to tolerate and maximize the amount of return that they can get for the given amount of risk that they'll take, then send them our way and we'll run this exercise for them. One of the other things, I don't want to step on your toes too much about how do you protect yourself in this environment that we've talked about in previous podcasts, is because this inflation is here to stay for a while. We're talking about investments and stuff, what people can do, but certainly if you have a big ticket item that you want to buy, or anything, if you want to buy, if inflation is going to cause the price of the things that you're going to buy, like a house remodel or something like that, to continue to go up 10 or 15% or more, then you're better off doing that now than waiting a year from now to do it. So that's certainly some, advice that we can help you with and figure some things out. If you want to give us a call or come into the office or send us an email. Go ahead.
The next thing that you can do to protect yourself is to know your timeline. Don't invest short-term money in the stock market. The stock market is a long-term investment vehicle. So 5, preferably at least 10 years for a time horizon as far as when you're going to need that money. Now, I'm not talking about when you're going to need to start taking out some money. I mean, if you have like a home purchase, or like something that you are saving for, that's kind of a short-term thing, the stock market is not appropriate for that, because there can be so much variability in returns over a short amount of time. Whereas if you are invested for a longer amount of time, the odds that your returns are going to be positive and good go up the longer that you're invested for.
So one of the things that we encourage people to do to try to reduce risk while they're owning companies, and particularly right now, what we're encouraging people to do is stay in United States companies or in the United States stock market. In those companies, foreign companies are always historically more volatile or more risky than United States companies, and also weight most of your portfolio to larger companies because they're less volatile than smaller companies too. And then finally, there's also, if somebody wants to transfer market risk away from themselves, they can do that with some different kinds of insurance products that we call them portfolio insurance, where you pay fees or insurance charges for these products, but they give you certain levels of protection, either for income or for a death benefit for your kids, or a combination of both those kind of things, but you got to pay for them. So it reduces your overall return over the long period of time, but that can give some people some protection to protect themselves. And then some proactive things that people can do regarding downturns of the market in the market. If we right now, the market's up for the day quite a bit and is looking pretty good, but that's not always going to be the case, particularly when we have a panic-driven sell-off, that doesn't make sense, that the intrinsic value, the real value of the companies, like what we're telling you, is really up here, but people panic and sell. There are certain things that you can do to be proactive to help yourself. For instance, that's a great time to do a Roth conversion, to convert IRA money. Your IRA is here, or it's here and then it's gone down a little bit. Well, why not, if you're thinking about converting from a traditional IRA to a Roth IRA, why not do it down here when you have to pay less taxes on the amount you convert? And then when it goes back up to where it was, all that growth is tax-free. So that's a good idea. If that's anything that you or anybody you know might want to talk about, we're happy to discuss that with you on the phone or in person. There's also, it might be a good time, if you own some individual stocks, to do some what's called tax loss harvesting. For instance, if you have a stock that really, isn't setting the world on fire, you just soon get rid of it, but you have a gain in it. Well, if the market goes down and your stock price goes down such that you can sell that stock at a loss or flat, and not have capital gains, that could be a good thing to do. And that's something we can talk to you about too. Then the final thing is if you have cash on the sidelines and there's a fear-driven or a panic-driven market drop, what a great time to get that money invested, because the panic and the fear will go away and the market will go back up. So.
All right, so we don't have any questions, it looks like, so we're gonna go ahead and close up. Thank you so much, everybody, for joining us.
If you have any questions, please email us at bob@bobbenny.com or
Jessie@bobbenny.com.
even though her name is Jessie Thompson, it's still Jessie@bobbenny.com. Anyway, you can call us at 421-2626 or email us. We want to help people, and we'll help you and your family and your friends with any kind of try to answer any kind of financial question you have, or help you solve any kind of financial problem that you find yourself in. That's what God put us here for, is to help people. We love to help people, and we'd love to help you or your friends or family. So also, if you have any feedback on the Bobcast, we sure would appreciate that you can send us an email and let us know how we can do better or whatever like that. But other than that, thank you very much and have a blessed day.
Thank you.